The Federal Reserve's reluctance to cut rates suggests the economy remains robust with more jobs, rising wages, and steady consumer spending. All of this should, in theory, translate into more shoppers filling Walmart's aisles. Inflation fears might motivate people to buy items sooner rather than later, worried that tomorrow's price tag could be higher than today's. Walmart, known for its low prices, has historically done well when consumers become more price-sensitive. Throughout inflation spikes, Walmart's image as the go-to budget retailer has helped it capture market share from competitors. So if market conditions are so favorable, why the cautious forecast? First off, Walmart might be playing a classic Wall Street game of underpromise and overdeliver. If they set the bar low and then beat those conservative forecasts, it can trigger a stock rally. This tactic helps keep shareholders happy and avoids the fallout from any earnings miss. Despite higher overall consumer spending, Walmart also faces significant wage pressures. A tight labor market forces them to offer more competitive pay, potentially squeezing profit margins. If they try to pass those costs on, they risk alienating their famously price-sensitive customer base. Inflation can push customers to Walmart for essentials, but if the economy starts cooling or household debt keeps climbing, discretionary spending could decline. That means fewer big-ticket or impulse buys, areas where Walmart has also been looking to expand. From port delays to supplier cost increases, Walmart's massive supply chain is vulnerable to disruptions. If they foresee inventory headaches, especially heading into the 2025 holiday season, they might be bracing for a dip in profitability or sales volume. If the Fed sticks to higher rates longer than expected, the economic boost we're seeing now could taper off by late 2025. Walmart's cautious stance might be preparing investors for a softer landing in 2026. Tariffs or supplier costs may force Walmart to raise prices, but announcing this too soon can spook consumers. Downplaying future growth might be a subtler way of prepping the market for eventual price hikes without making headlines. So perhaps, even though they claim that they are not considering tariffs into their forecasts, they really have. If Walmart projects a less stellar year, they could be signaling to suppliers, hey, we're tightening our belts, don't hike those wholesale prices too much. This negotiation tactic helps Walmart retain its low-cost edge. So, what's the real takeaway? Walmart's subdued forecast might be more about financial positioning than genuine pessimism. They've proven they can excel when consumer budgets are tight, and if spending stays robust, Walmart could continue reaping the rewards. But they're also preparing for rising costs and potential shifts in how and how much people spend. Curious to see if Walmart's conservative outlook holds true over the next few quarters? Subscribe and turn on notifications for more news analysis like this.